Welcome into this week's On the Spot. I'm Tony Mulvey. Kevin, joined by Kevin Hill. Kevin, how are you?
I'm doing great, Tony. It's doing great. Yeah.
Awesome. Well, we're gonna touch a little on what's going on in the spot market this week, and really we've started Q3, and where do we kind of go from here? And we'll bring in some charts, volumes, rejections, and rates, and kind of show how they've reacted over the course of the past few years, right? Even dating back to 2019, to kind of give an insight and play on where are we going to go from here, and what does the market look like now in comparison? I think everybody knows that we're still higher than 2019 levels, but I think it gets really interesting when you start to look at the trends that we've seen in the market. They start to look eerily similar to 2019. So we'll bring up our first chart. It'll be our outbound tender volume index. You'll see in the white line, that's this year's volumes. The green line's 2021, the blue line 2020, and the orange line 2019. What you see, I mean, it's almost a spitting image of what we saw in 2019, just about 10% higher.
Yeah, it is. It is just a replay of 2019, going in here in the 4th of July. Coming back up, and I would imagine we're pretty well flatlined at this level, or around this level, for the rest of 2022 here. And there's not much out there or green shoots or encouragement that the freight market's going to move either up or really either down from this position we're at right now.
Yeah, I mean, it's one of those, what was the new normal, right? We always knew last year wasn't sustainable at those levels, and the odds of getting back to sub 10,000 on OTVI didn't seem really feasible either. So we were always looking for, where's this going to kind of level out? And it seems like we're kind of in that space. I mean, June was pretty soft, and you saw further deterioration of volumes, but it wasn't as significant as what we saw earlier back in March and April. So I think you're spot on when you talk about kind of leveling off at this throughout the rest of the year. I mean, obviously, if the consumer continues to take hits in those further recessionary periods and inflation hasn't yet peaked or things like that, I mean, there are impacts that could drive this lower or drive it higher. I mean, there's two, but I mean, right now, kind of where we're sitting seems reasonable. We'll move on.
And we look at we look at truck capacity, and we can throw the graph back up there, the Sonar chart. If you look at truck capacity, it's not enough to serve that green line, which is 2021, right?
Yeah.
But it's above the white line, which is our current state here at 2022. So our capacity is a little bit more than the volumes that we are looking for right now. And in 2022, probably a stabilization, flat line, as we said. So it's going to be an overcapacity environment for the levels that we're at right now.
Yeah, we'll bring up the outbound tender reject index. I mean, we'll see it right here. It's perfect example. It's moved down slightly, but I mean, it's really started to flatline as well. But you look back at 2019, and it did the same thing, right? And I think what's interesting, though, is what's happened here kind of in the beginning of the month, right? We've seen kind of a slowdown in rejections, which is kind of atypical. I mean, it's not what you really see around the 4th of July. There's a little bit of a reason behind that, but I mean, this was kind of that trend that we've been seeing, is this downward movement. But do we get back to 5%? I don't really know. I mean, it seems like we are headed there, but really slowly. But I mean, as we talked about contract rates,
6%. Oh, go 5%, 6%, 7%, 8%. It's all kind of about the same thing, right? It's a far cry from 22% and 23%. You know, so 7%. We might be headed down to 5%. We might not, but right now 7% is a very low rejection rate that is the sinking rates.
Yeah, and I think that's the key. I mean, we've had this conversation about contract and spot rates, right? And contract rates really haven't rolled over like spot rates have, but now we're in Q3. And what's that mean? I mean, you would anticipate RFPs coming online as shippers kind of kick the can down the road in Q2, well, now into Q3, have they taken some action with new RFPs, new contract rates? My guess is they probably have. And that's part of it. And obviously, carriers don't want to break the contracts because they have the benefit of fuel surcharge.
Yeah, we were reading Bank of America's, state of trucking, and they have a couple quotes from shippers saying that they're starting to see not only spot rates below contract, but also they were expecting double-digit reductions in contract rates. I know we were talking about that earlier this week, and the double digits is a big number right now to come off of a contract rate and negotiate down. But this is what their channel checks are showing.
Yeah, I mean, even at 20, I mean, you start looking at what 10% would be of a contract rate where it's at $2.97, right? I mean, a 30-cent decline is right there in that. It doesn't seem that far off. We'll bring up our next chart, and this kind of shows why it doesn't seem that far off. When you start looking at spot rates excluding fuel at what, $2.04? I mean, you'd still, even with the 30% or 30-cent decline on contract rates, you're still at $2.60 a mile.
You're still at that $2.60 a mile. The gap between contract and spot is over 90 cents. I think it's a little bit wider than it was a week ago, and this is depending on what it doesn't mean depending on what fuel does. So this is the current new state of the market right here.
Yeah, we'll bring up that last chart. We do have that rates chart, basically the difference between that initially reported spot rate or initially reported contract rate and that line haul spot rate, that NTIL. You see it at 96 cents. It's the widest it's ever been. You look back into 2019, they were always right around that, 20-cent range. Mm-hmm. Basically, spot rates minus fuel, 20 cents below contract rates. We're talking at 96 cents right now. So you're definitely seeing that the need to lower contract rates, right? This isn't a sustainable period for a long time. I mean, even look back at 2020 when we saw the pandemic. I mean, you see it drop pretty significantly and rebound pretty fast, but that's how the whole market reacted.
It is, and everyone likes to throw out the new normal, so I'll throw out the new normal. This is our new normal for the time being. It's not going to be forever, of course, but this is the new market cycle, and we should all get used to talking about freight like this, about capacity and demand, and kind of that it is not going to be, rejection rates of 22% and $4 spot rates, that it's going to be pretty stable and flatlined. And we saw it in 2019. And unless there's some external shock, we're going to probably see it the rest of 2022 and into 2023.
Perfect. Well, thank you for joining me this week, Kevin. We'll be sure to check in on everything else you're doing here at FreightWaves. But right now, we'll toss it to a quick break and be back with more FreightWaves Now.